So our analysts have been providing top quality insight all of 2024. What stocks do they have their eyes on for 2025? Let's check in.
Yeah, first off, we think the market on a whole is poised to see some improvement in performance in 2025. One of the key drivers that we think can contribute to this is the policy rate changes in Jamaica, because as we've seen and expect further rate cuts in the US from US policymakers, and we expect that to have an impact on the decisions of the policymakers in Jamaica. Now, as a result of that, there's several names, of course, in the market that are expected to do well. But right now, I'd like to highlight two of them. So two names that I think you can, take an eye on and keep an eye on in 2025 are NCB and Jamaica Brothers Group. So let's take a look at Jamaica Brothers Group first. So with Jamaica Brothers Group, what we've seen recently is that they did a sale of some of their assets in the United States, netted them a gain of $2.3 billion. The idea behind that was to increase efficiency at the company because they expect to save about $1.5 million a year from the sale. So we expect the company to continue to make moves like these in order to increase the efficiency of the company. That, along with the steady growth in revenue that we've seen in the company over the years, I think that set them up well. Additionally, as I just said earlier, falling rates would bode well for them because it is a company that has a significant amount of debt on its balance sheet. So, lower price on those debts would bode well for them. Now, another one, as I said earlier, is NCB, that we think is very positive, very well. Of course, as we know, recently, for several years now, NCB stock has not been doing so well. Several, major changes occurred at the company, and you see some restructuring happening there in terms of leadership and all the direction. We expect a lot of the fruits of these decisions to bear fruit, in 2025 and beyond. We expect increased efficiency at the company, as they've been continuing to try to articulate to investors, to get that cost to income ratio down. Getting that ratio down alone would be, add billions to the bottom line. So that would bode extremely well for them and investors. Also, a falling interest rate environment would also bode well for them, as it would push down the interest expense on the company's income statement, which is a major expense item, for financial institutions. So that would do brilliant for them. You put those two together, you can have a very good 2025 for the company's performance. And then as a result, you could see an uptick there in the stock price. Also of keynote is the dividends. The dividends are back. It's been consistent for some time now, not quite at the pre-COVID levels, but there is room for improvement there, of course, as we see increasing profitability at the company. So those are some of the takes for 2025.
Good evening. My name is Darren McGregor, Head of Investment Research and Portfolio Advisor at Barta Investments Limited. And today I'll be talking about two stocks that you should be watching for 2025, Scotia Group and Jamaica Brothers. Now, both of these stocks exhibit strong fundamentals, attractive valuations, and are strategically positioned for further growth. Now, in looking at a few of the reasons why I think Scotia Group is attractive, they've achieved pretty healthy revenue growth over the last few years and have done so while keeping costs fairly contained. Now, looking at their cost to income ratio, it stands at about 50%, just under 50%, which is among the lowest in the industry, while still managing to achieve pretty healthy revenue growth. Combined with that, they have a pretty strong risk culture, which bears out in their non-performing loans to total loans ratio of 1.6% relative to an industry average of 2.5%. And also, while containing the health of their loan portfolio, they've managed to grow their market share. So their market share in loans is at about 23% now, up from around 21% last year. And all of this supports a fairly healthy return on equity of roughly 14.5%, which is fairly commendable looking at where the rest of the industry is at the moment and some of the developments in the industry over the last few years. Right? Now, looking at the stock from a pricing standpoint, the price to earnings ratio is hovering at around 7.88%, which is from a historical standpoint on the lower end. I think the last time we were around these levels for the stock was somewhere around 2014, which when you look at the development of the fundamentals of the company over time, it's much more attractive than it has been in recent years. So that makes Scotia a fairly good buy in my view. Looking at Jamaica broilers, it's a similar story, but I think there is much more of a growth story behind Jamaica broilers. The geographic diversification of the company bodes well for them between their Jamaican and US operations. The US operation is a fairly strong growth catalyst for them. It will be a strong growth catalyst for them in the years to come, and it significantly increases their addressable market relative to the confines of the Jamaican market. Now, in looking at how the company has done recently, growth in the last quarter was fairly muted. However, tying it back to that strength that comes from the geographic diversification, what you saw was that while the Jamaican market was heavily impacted by Hurricane Beryl, the growth in the U.S. market, helped to bring the company towards an overall growth in revenue for the period, right? And just looking at how the company is run, they've managed the company very well. They've handled the outbreak of avian influenza in the US fairly well, and it doesn't seem like there's any material impact to the company from the outbreak in their US operation. So that lends a lot of confidence to the management of the operation of the company. Again, this is a stock that is fairly well priced from a PE standpoint, standing at 6.41%, which again, we haven't really seen this type of pricing in the stock since maybe about 2015, 2014. And again, looking at the growth that the company's achieved in recent years, you're looking at a much more attractive stock than you would have seen in, say, 2020, 2019, 2018, relative to where the company is now, given that they've discontinued the Haiti operation, which has been a fairly significant drag on the company. So the company is very well poised for growth, all while being poised at a fairly attractive valuation.
My stock to watch is Microsoft. It's now trading at $436.60, but there is a very high chance of it having a stock split at some point, especially because it is widely followed and the fact that tech is a sector that is driving most of the returns on the market. So Microsoft is not as hardware driven as many other tech companies. It is largely software driven, and because of that, the return on capital is likely to be higher. And because of how widespread Microsoft's reach is, it is very hard to disrupt. It is a part of everyday office infrastructure and technological infrastructure overall. And we know a lot about gaming, we know a lot about the Xbox segment. Even though it doesn't have as much market share as PlayStation, it has a niche following, it has a cult following. And there are many other reasons why there should be significant upside for Microsoft. Next year is likely to see a continuation of the bull market we're seeing right now because of the end of the hiking cycle by the US Federal Reserve. Even though the Fed has been a bit more hawkish, the fact that rate hikes have not been on the table for a little while is a significant catalyst for those returns. And all of these factors come together to make a compelling case for considering Microsoft.
Thanks, guys. So, what do you think of their picks? Let me know in the comments.